Hey, this is Sasha. Thanks for joining me here for another episode on Hungry for Returns, where I answer your trading and investing questions. In today's episode, what we're going to do is take a look at strike prices and the difference of going wider in strikes. So that's the question. If you have a specific question you want answered, just go to our website, tradersfly.com. You could go to the support tab over here. There's a submit voice question here, and it'll take you to a page similar to this, and you can record your own question, and that way we can be more detailed to answer your question on video. But of course, when you're there, definitely check out some of the products and courses, which helps out all the employees, all the team that we have in order to post these videos, do the descriptions, because I don't do all of that. And there's a team that helps me out, and all these other great courses that could be very beneficial for you to help you out in your trading journey. So let's take a listen to this question. I'm going to go ahead and answer it for you here in detail.
Hey Sasha, when building a vertical spread, how do we know how many strikes to have our vertical spread apart? So, I know that we can build a vertical spread from the 170 strike and the next strike, which is say 167.5. Also, we could build the same vertical spread choosing the 170 strike and the 165 or the 160 strike. So my question is, how do we know how many strikes apart set our vertical spread? And if there is a easier way to calculate that, maybe from the Analyze tab on Thinkorswim. That's my questions. Thanks so much for everything you do, and I love your channel. Thanks.
All right, so that question was from George. Thanks for submitting your question in. So I think it's a good question that we'll go ahead and just take a look at right here. There's a lot of strike prices that really you could choose from. When we go ahead here, take a look at the screen. I'll just do my best to answer your question here. So normally when a lot of people look at strike prices here, it really doesn't matter. You go 22 days, 36 days for this example. So as we check these things out, you can see, okay, well, currently we're right around the 190 is at the money. Okay, we're right at 193 on Facebook. And I think, using the 160s, this is probably the closest. So if we're looking for a vertical spread, yeah, we could go, okay, here, current price is 190. Okay, well, if I look for 160 and 155, or I look for 160 and 150, or do I choose 165, 160 and 145? So there's a lot of choices and options right? No pun intended. So a lot of choices there that you could go ahead and pick when it comes to strike prices. So ultimately, I would say the biggest and probably more important thing to choose is to go ahead and choose a strike price where you're short. And that's kind of where you want to cap it off. So if you're buying a vertical spread, that's kind of the more important one, because there you're going to be at your probabilities, right? So if you're short, like let's say I'm selling a vertical, I want to make sure my short is either at 8% or 12%. If you're buying a vertical, well, it's kind of like, where do you believe that stock's going to hit? So where is going to be your cap off, right? So let's say I'm buying this vertical here. And just to analyze it right here, and we'll just do, let's just say 5 contracts, just for conversation's sake. So here it is. Here's our vertical. And the more important one here, what I'm talking about, is if we assume Facebook stock is going to go down, right, because we're buying a put vertical, same kind of concept if you're buying a call vertical. So here, what I'm looking at, the more important strike really is, I would say, the one right here, because that's really where you start becoming profitable, and that's also where you're going to be positive and kind of in your sweet spot, right? So that's going to be your sweet spot. If I was doing something, let's just do a call here on this side. If I go ahead and buy a vertical on this side, and we're looking for a longer term trade, the more important one, I would say, okay, well, it's going to be right here, because this is where now, hey, I'm in the safe zone. Anything above that, I'm really, really safe. So look at those areas first. Now, here's the big question. Okay, so if we're going to the upside, well, do I choose, let me bring this in a little bit. Let's say, okay, we got a 200 and a 210, or a 195 and a 200. So now do I choose a 195 and a 200, or do I choose a 195 and a 205? Well, if you already know which one you chose up there, now the question is, okay, do I go 195 and a 190? because now that starts to spread out. So you can see what happens is that as you start spreading this strike, and I could even go 185, I could split it where I'm over here and right in the middle. What's going to happen is that you ultimately are going to put up more cash or capital the wider you get on your strikes right here, 185 and a 205. So if you have a little more cash and you have a little more capital, and you just want to do a couple contracts, sometimes it's fine. I mean, I've seen people do vertical spreads where it's like at 130 and a 205. And it almost looks like a naked, but it's not naked because it does cap you off eventually, and it saves a lot of your margin. So you could almost do this, and they ultimately do this more so for when they're selling verticals. Like let's say we're selling a vertical, and that way they have a rapid theta decay. So if I go ahead and let's just say here's our vertical, okay, we're selling that vertical. I'll go 180, 190, let's say 185 right there. Okay, so now a 1 point difference or a 1 strike difference, I'm using $397, but that's not a lot of money when you compare it to most people's accounts. So let's say we bump it up to 6 or 7 contracts. Now all of a sudden I'm using $2,793. Well, do I really want to trade 7 contracts when I could just go ahead and trade maybe 7 contracts is nice because, well, you could take off 1 or 2 into strength. But let's say I just want to trade like 2 or 3 contracts. Well, instead of doing 7 contracts with $2,000, I could just do 3 contracts, but I could just widen this out a little bit more. And now I got about a $2,500 capital invested. And, it gives that power of that theta to kind of work a little bit quicker. So for example, if I'd go with 1 contract, right, and I do the 180 to 185, my theta is $1.14. But all of a sudden, if I go to, let's say 140, which is way out of the money, my theta is 5.72. Now, of course, you're using more cash and capital, yes. But the point is here, you're not using as much cash and capital as a naked strategy because you're still capping off your losses, but allows that theta decay to kind of work as quick or as close to a naked position as kind of possible without using that same margin requirement. And that's kind of when you may want to go ahead and, play with these strikes. So whether you choose a 1 strike and like 2 or 3 contracts, that's okay. But once you start trading, maybe let's say, I don't know, I mean, everybody's at different points. So let's say you're trading 50 contracts, but that's a little high and you don't want to trade 50 contracts with 1 strike. Well, why trade 50 contracts with 1 strike difference if you got that kind of cash? You got about $20,000 you want to put into the trade. Well, instead, why don't I just go a couple strikes further out and maybe do right here 10 contracts or so. And now I'm kind of still using $20,000 in cash, but a little less contracts. Sometimes it's easier to manage because now all of a sudden, if I do need to make an adjustment, I could go ahead and just adjust with a couple of contracts, 2 or 3 contracts. Whereas with more contracts, sometimes the adjustment is more expensive or, there's a lot of other factors you have to consider. So that's kind of my thoughts on, going 1 point or 1 to the next strike or multiple strikes is, don't get too crazy or too wrapped up into it. You could do 1 strike, you could do 2 strikes, you could do 3 strikes, but really look at your capital requirement and the trade because going into different strikes will affect them a bit differently. Just simply because they're at different points, they're at different probabilities, they're at different deltas. So it does affect it to some degree, and also the capital, the margin. It's not all equal, but that's a basic idea and thought and concept that you could go ahead and think about as you're putting on your trade. Because if you're starting to trade, like let's say 10 contracts, but 10 is a little high, you could go with maybe 3 contracts, but widen it a little bit. And that maybe will help you find a balance. And with time, as you do more trades, you'll see, hey, well, I like this as a sweet spot with 3 contracts or 7 contracts, or I like a little wider, a little less wide on these types of trades, like butterflies, for example. Let me see here what I got. AutoZone, butterfly here. And you can see this one, I went with 1170. It's a higher price stock, but I did basically a 50-point spread or so, or yeah, about 50-point spread on these contracts because it's a butterfly and it's a higher price stock. Other times I might do it closer because with a $200 stock or a $100 stock, I might only do 2 strike differences. With a $1,000 stock, I might do, 50 points, 60 points. It's just, you'll start looking at it because of your dollar factor, because of the Greeks, what they say, and you kind of start gauging it based on that. And the more times you do the same trade over and over, meaning if I did an AutoZone every single month, you kind of get an idea of the strikes you kind of like and the ranges. So anyways, I hope that's helpful. It gives you some insight on these kinds of things. I don't think I have another one example on, no other example at the moment on strike differences, but hopefully you got some out of that to give you some things to think about and a starting point. Anyways, thank you so much for joining me. If you have a trading investing question, feel free to hit out our website at tradersfly.com, submit a question by voice just like George did, and then you can get a detailed answer like this. It's like a mini coaching session. But if you just want to hang out on YouTube, totally okay. Just hit the subscribe button here. That way you don't miss any other videos, or join our newsletter list. That's where we release other great videos, content, material, courses, books, other great stuff I have coming up, and sometimes deals, discounts, promotions, coupons, you name it, the works. All right, thanks again. Remember, do what you love, contribute to other people, but most importantly, live life abundantly. See ya.